Assalamualaikum and have a nice day everyone. I am from group number 5 and this is my group members. Eli Nurdiana, Intan Nur Farhani, Nur Atika, Nurul Nazira and also me, Robia Omar. So legal case study that we choose is Lehman Brothers scandals on 2008 and also Satyam scandals on 2009. So now I will be presenting the first legal case study which is Lehman Brothers scandal. Enjoy! Fact of the case. So the main player in this case are Lehman Brothers Executive and the company's auditor, ERNST and Young Global Limited, called EY. Lehman has invested heavily in real estate market, but when the real estate market has begun to show signs of weakening, they had difficulty to sell their assets to cover their liabilities and the firm couldn't raise sufficient fund. Long short story, in September 2000, after statement of Financial Accounting Standard 140 permitting certain repos to be treated as sales rather than financing, Lehman began to perform this scandal by using Repo 105. Lehman removed the securities transferred as collateral from its balance sheet and recorded the cash received as sales. By using this trick, they successfully translated the loans amount to $15 billion into revenues. But then, fraud was later discovered when they filed for bankruptcy on 5th of September 2008. Liability of auditor is liability to third parties under common law. So EY served as Lehman's auditor from 2001 until Lehman filed for bankruptcy in 2008. Anton Valuka's court appointment examiner questioned Lehman's accounting method and the role of EY that approved Lehman's method for the Repo 105 transaction. So then, Valukas concluded that Lehman's statements were misleading and reported EY for negligence and malpractice. So in December 2010, the New York Attorney General Andrew M. Cuomo filed a lawsuit against EY for approving such accounting treatment for Repo 105. So the audit firm has agreed to pay $10 million for the lawsuit, which will go to the Lehman's investor and the state. Once again, in October 2013, EY had to pay $99 million to settle a lawsuit by Lehman's investor that claimed the audit firm looked at the other way at Lehman's use of the Repo 105 transactions. Auditor defense. First is non-negligent performance. So EY contend that it had done no wrong and it stood by its opinion that Lehman's financial statements had been prepared in accordance with generally accepted accounting principle GAAP and that Lehman's bankruptcy was not caused by any accounting issues. The second one is lack of duty, which is William Sledge, the EY partner, state that even though EY had never evaluated Lehman's Repo 105 accounting policy to see if it was a sound interpretation of SFAS 140, they did not approve of it. He also insists that EY was not required to review the timing or volume of such repo transactions. That's all from me, thank you. So I will pass the presentation to my friend Atika to presenting the second study case.
Next is Satyam scandal. Satyam Computer Service Limited was a rising star in Indian outsourced IT services industry. The company was formed in 1987 by Ramaningala Raju and offered IT and business process outsourcing (BPO) services spanning various sectors. Satyam was an example of India's growing success. By 2003, Satyam's IT services business include 13,120 technical associates servicing over 300 customers worldwide. Okay, first, facts of the case. On January 6, 2009, it was said that Raju and his brother had been manipulating the company's accounts for years. They were found guilty of fabricating the invoices, manipulating the company's record, income tax returns, and inflating the company's revenue. PricewaterhouseCoopers, PwC, a major auditing agency, examined Satyam's financial record from June 2000 until the fraud was discovered in 2009. The audit firm received strong criticisms for its failure to spot the crime. The $1.04 billion Satyam claimed to hold in non-interest-bearing deposits on its balance sheet was one particularly unsettling figure. Furthermore, it seems that the auditors did not independently confirm with the banks where Satyam claimed to hold money. Next, the liability of the auditor, duty owed. Criminal liability for accountants. The U.S. Securities and Exchange Commission (SEC) penalized PwC India with $6 million for failing to discharge its obligations related to the auditing of Satyam's financial records in accordance with the auditing standards and code of conduct. The Securities and Exchange Board of India (SEBI) also prohibited PwC for 2 years from providing audit services to listed firms and market intermediaries. One of the SEBI members claimed that the auditors had not provided any proof that they had carried out their duties with the necessary standards of professional duty and care. The auditors were fully aware of the consequences of their actions, which in the eyes of the SEBI Act and the SEBI FUTP regulation would elevate such cumulative and aggregate acts of gross negligence and commission of fraud. Lastly, auditor's defense, non-negligent performance. According to a PwC representative, the company did nothing intentionally wrong in the unprecedented management-driven fraud at Satyam, nor have they come across any tangible evidence to the contrary. According to PwC, it is necessary to demonstrate that the auditor exercised reasonable care and effort during the auditing process rather than acting as a detective. A week after Ramalinga Raju's confession, the firm eventually claimed that their audit report was flawed because it was based on false financial statements provided by Satyam's management. Overall, we can see that the auditors, EY and PwC, were liable and held accountable for the accounting scandal and fraud in both cases. These serve as reminders to the present and future society so that the same mistakes will not be repeated again. Thank you.